Hi everyone, welcome to the fourth episode of Direct Stock Investing series. This video is going to be one of the most important video of the entire Direct Stock Investing series. Why? You will come to know as you watch further. So let's begin. In the last three episodes, I primarily talked about how a company forms, who are the investors, what is a stock, and once you list in the stock market, how one can buy a stock through a broker, what is a stock exchange. And then we talked about dividend buyback, stock split in the previous video, right, in the episode 3. So now we are entering into much more deeper levels. When I say deeper, this episode is mostly we talk about the ratios. So in this video, I will talk about two important concepts. One is market capitalization of a company and price to earning ratio. I'm sure that most of you might have heard about both of these two terms. So let's dive deeper into that. What do you mean by market cap of a company, right? In the previous videos, I talked about shares, how a share is created, and how a price derived in the stock exchange, right? So market cap is nothing but when you talk in terms of formula. So in this video and in the upcoming few videos, we talk about in terms of mathematical calculations and formulas. That's the reason I told at the beginning that if you want to become an investor, you need to know basic understanding of mathematics, right? Little calculations here and there, multiplication and divisions. So market cap is derived by the following formula. So market cap is equal to number of shares multiplied by the share price. Number of shares outstanding multiplied by the price of one share. For example, let's take our company, right? The company ABC. If the number of shares are 10,000 and each share price is 10 rupees, the market cap of a company is 1 lakh rupees. So it's like how big the company is. Now let's talk about the real life example. Say for example, in case of ITC, right? Number of shares outstanding for ITC is 1253 crores as per screener data. And the current price of ITC is around 330, 329, 330 rupees, right? So if you multiply 1253 crore into 330, you will get around 4,10,000 crores in that range. So you can verify the same in screener website or any website, money control, anywhere. That's how the market capitalization is calculated. Now, why this is important? The market cap of a company, the size of a company, why it is important? Basically, we can categorize companies into broadly into three caps. One is large cap, one is mid cap, and one is small cap. So what are large cap companies? The definition, as per the definition, the top 100 companies by market capitalizations are considered as the large cap companies. So when I say market cap, again the same formula applies. So that much big, like the top 100 companies, the biggest companies by market capitalization, those are large cap companies. And what are the specialities of large cap companies? They are fairly large companies, very good business model. They are running from quite some time, right? The profitability aspect for most of them will be clear. There is predictability. There is good liquidity in the stock market, meaning more buyers and sellers will be there because they are well-known companies. And because of that, relatively less risk if you invest into large cap companies. So even the returns also will be moderate or low compared to mid cap and small cap. I'll talk about them in a minute's time. Yeah, if you're investing into large cap companies, they pay decent amount of dividend because they are profitable, high profitable companies. They pay part of their profit as dividends to their shareholders. Less risky while investing, same time returns also can be moderate to minimum. Now let's talk about mid cap companies, right? So again, in terms of market capitalization, from 101 position to 250th position, those 150 companies are called as mid cap companies. They are growing companies, decent business model, but not as big as, or not as they are not making as much profit as large cap companies. Because of that, they have decent growth potential, and there is a considerable amount of risk also, right? It's a relatively small company, so there is a possibility of market correction of business, disruption in business model. It can impact mid-sized companies more. But historically, if you take mid-cap companies, if you are able to pick the right kind of stock, mid-cap companies had given monumental returns, right? That's why direct stock investing, learning about direct stock investing is important, because there are a lot of germs in these uh, stocks, but you need to pick the right one. Now let's talk about small cap companies. So anything beyond 250, right, 260th position, 300th position, 500th position, uh, as per market capitalization, those companies are called as small cap companies. They are small in size, still very nascent in growth. Uh, Profitability is also less. Liquidity is less. Number of shares outstanding will be less. So liquidity problem will be there. Not all small caps, but for some of them. So because of that, there is risk while investing in small cap companies. But good small cap companies have enormous growth potential. Because of that, if you invest into the right ones, you can make uh, generational wealth if you can pick one or two good quality small cap companies, right? So yeah, in my upcoming videos, I will talk about how to pick the right kind of stocks. So this series is going to be extremely beneficial for all of you. So let's wait till those episodes. So these are the three sections of companies as per market capitalization: large cap, mid cap, and small cap. So I hope market cap is clear. Now let's talk about the most important metric while investing into stocks, which is nothing but the price to earnings ratio, PE ratio. This ratio is nothing but this defines the valuation of a company, meaning whether the stock price of a company is pricey or not. This PE ratio will decide that. Right now, let's understand what is price to earnings ratio. So the formula for PE ratio is price divided by earnings per share, EPS. So now you heard one new term called EPS, right? So we have to define EPS also. Let's go slowly, one step at a time, one by one, so that you will get complete clarity on what I am talking about. I talked about PE ratio. PE ratio, the formula to calculate PE ratio is price of the stock divided by EPS, earnings per share. Now, what is earnings per share? Earnings per share is calculated by the profit that the company generates divided by number of shares outstanding. Say for example, if a company is making 100 crores or 100 crores rupees in a year, okay, the profit of a company, and the number of shares for that particular company is 10 crores, right? Now the EPS, earnings per share, I want to calculate how much each share of the company makes, right? So earnings per share, 100 divided by 10, 100 crore divided by 10 crore, that is 10, right? So each share makes 10 rupees. So total 10 crores multiplied by 10, 100 crores. So earnings per share, each share makes 10 rupees. That is EPS, earnings per share. Hope it is clear. Now let's divide that 10 divided by from the price. So price to earnings ratio is price divided by EPS. We calculated EPS as 10. Now let us suppose the price of the stock currently in the market is 200 rupees. Let us assume. So 200 divided by 10 is how much? 20, right? So price to earnings ratio of this particular stock, the example stock, is 20. That means for every rupee the company generates, the person or the market is ready to pay 20 rupees. Now, this may be little confusing for you because if you are someone new, it's very basic thing or it's completely new for you, right? So 20 P ratio 20 of a company right now in current market circumstances is something uh, very low. Not very low, but it can be considered as a cheap stock. It's not overvalued or again, there are a lot of other parameters also. If the sector itself has very low PE, then it's very subjective. The PE ratios can be subjective. I will talk about it, but let's think in a broader sense. 20 PE ratio is relatively less because there are many companies that the market has given 50, 60, 80, 100 and all, right? So 20 PE ratio is like okayish. We have to see through a lot of other data to come to a conclusion where whether I can invest into a stock having a PE ratio of 20. You can't directly jump since the PE ratio is very small or it's just 20. Let me invest. No, that should not be the case. You have to see there are other data as well. Only after that you can go ahead and invest into that kind of stocks. We'll talk all in the upcoming videos. Let's not worry about that. So for the time being, let's stick to market cap and P ratio. Two important terms. I hope P ratio is extremely clear, right? Now, as I said, as we move further, we will dive deeper into other financial ratios like ROCE, ROE, price to book. I have written few other ratios as well. Maybe if required, we can talk about that as well. But I won't talk more things because I will mostly cover the terms that are extremely important for direct stock investing. I feel this, if you understand market cap and PE ratio, EPS, you have covered almost 50% of the things that you have to consider before investing, the parameters that you have to consider before investing. So as an exercise, what you can do is open Screener website, open multiple stocks and see what I talked about market capitalization. Verify the formulas. Market capitalization is equal to number of all these data are available. Number of shares outstanding, price, anyway it's available. You can verify whether the data is matching or not. Same with PE ratio. Open ITC's detail page in Screener. There will be market cap. You can edit the ratios, add all the ratios, market cap, price to earning, EPS you will get there, then price is anyway there, and calculate market capitalization, calculate the price to earnings ratio. Do the same for multiple companies and do a comparison between multiple stocks from the same sector and see which stock has less P ratio compared to the other one, which stock is expensive and which stock is cheap. This is a very good exercise for you to understand the value of a company and you will come to know whether to invest or not, right? And see whether the sales and growth, net profits are increasing or not, right? Because EPS, earnings per share, is directly driven from the net profit of a company, right? So do this as an exercise. See as many companies as possible, understand all this in detail. And when I talk about other ratios in the next video, you will get more clarity, right? So let's do that exercise. And if you have any questions or concerns, please comment below. I'm more than happy to help you. And if you're liking my content, do subscribe to this channel. And if you have any suggestions for me, again, please suggest those things in the comment section. So yeah, that's about today's video. I will come up with the episode 5 shortly. Stay tuned.